Hello everybody, welcome to this recording. So the last time we spoke in class, we were still busy with a 4-part lecture series where I was taking you through the various allowances and the inclusions that one gets. And in particular, our focus was with regard to a trading entity. The most common kind of trading entities we said are twofold. One is companies and closed corporations. And secondly, we also looked at the sole trader. So we then navigated ourselves through various allowances and inclusions that a trading entity gets. And now in this video, we're going to pick up and we're going to actually take lecture 4 and carve it out into 3 lectures. We're going to have a 4.1, 4.2, and a 4.3. So in 4.1, lecture 4.1, what I want to cover is just 2 issues. The first issue I want to deal with is one issue I did not get to in class, and that is a suspended sale agreement. You would recall that when the last we spoke in class, I actually dealt with both the VAT and the income tax implications of a finance lease. But now we still needed to sort out that paragraph A of a installment credit agreement. And in this lecture, we're going to now get to that specific issue. The second issue I want to cover in this video is actually the last deduction that a trading entity can get, and that, as you know from undergrad studies, is your section 18 capital A deduction to a PBO. So let's kick off. Let's have a look at the 2 issues. We're going to now start off firstly with a suspended sale agreement. We're going to actually look at section 24 is our section in this particular context that we are going to go to. And the issue that we're dealing with, let's just go to a suspended sale, remind ourselves what the issue over there is, and then have a look at what the Act is going to do and how it's going to sort the problem that we're basically facing with. So generally, when you sell a good under a suspended sale agreement, quite normally there would be finance costs, and purely for that reason, we then meet the 4 requirements that basically we find in paragraph A of an installment credit agreement, right, for VAT purposes. And that then tells us how to deal with the VAT consequences. We know that if it meets the requirement part A of a installment credit agreement, the time of supply is the earlier of delivery or payment, and the value of supply is then the full cash value. It's going to be declared upfront by the seller, and also you then know that the buyer can claim that upfront as well. So that's simplistically the VAT implications, but what do we then do with the income tax implications? So from an income tax point of view, the general fallback in this scenario is that when you sell a good or service which is linked to a suspended sale agreement, for example, the sale does not take place until 50% deposit is paid. That technically then means that the sale only happens when 50% deposit is actually paid down. That simply means that you got, and it comes from the wording that we are dealing with a sale that has been suspended by a clause that is sitting in the agreement itself. So when one then unpacks that from an income tax point of view, and when we look at the seller, obviously we turn to naturally the gross income definition, and the gross income definition says that the total amount in cash or otherwise received by accrued to. Now, the amount is only accrued to you from court cases you've studied when you have an unconditional obligation or entitlement to that amount. That your court cases, the principles from court cases will tell you that that sale did not actually occur until you have an unconditional entitlement to that amount. Okay, so obviously if there's a suspended sale clause, technically from court cases that is telling us that that amount has not accrued to you. However, if we then basically go to section 24, what section 24 does is it does 2 things for you. The first issue it's going to do is it's going to create the problem for you, because when you read section 24, it actually overrides your court cases, and it says, hang on, if you sell a good under a suspended sale agreement, the whole amount is deemed to accrue to you on day 1. Okay, now that in itself creates a problem for you, because now once the whole amount accrues to you on day 1, even though you did not receive any income, technically, if we run the gross income framework of computing a tax framework, one would then understand that that company would then have to pay income tax of 28% on day 1, even though not a single amount has actually been paid to him. So that creates a problem. But what section 24 then it does for you is it actually gives you a solution as well. And the solution that it's basically going to do for you is it's actually going to say, we're going to basically give relief under the circumstances. We know we've created a problem for you, and the problem is that you now need to pay tax upfront on an accrued amount, even though no actual payment has been received. We will then sort that out with a relief provision or some kind of a relief that's going to come your way. So let's have a look at the relief they're going to give you. They basically are the scope of the section. Let's kick off with that. It says where trading stock is sold under an ICA, and here we're actually referring to Part A of an installment credit agreement as defined in the VAT Act. The whole amount, excluding the finance charges, is then deemed to be gross income. So that's your scope of Section 24. It obviously is creating a problem, as we can see that, and the problem that we now have is that we've actually this entity will have to actually pay 28% on this entire amount, even though no payments may have actually come his way. Okay, let's have a look at the relief that or the solution that the Section 24 is going to give you. And what it's going to do is going to say that the relief is going to be provided on a gross profit percentage calculation. So we actually technically, can you see, we are going to a cash flow. We're actually going back from the accrual system, and because we're using the GP percentage, the point that I want to make there is that what we are trying to do is we're trying to go and follow the cash. As you know, GP percentages will follow the actual cash itself. Let's have a look at it. A further requirement is that at least 25% or more of the total amount is then due or payable within 12 months after the conclusion of that contract. That's a very logical scope requirement that I think we find there, because if you think about it differently, if this taxpayer got 75% or more, 75% or more of the income of the payment, then he doesn't actually have a problem because he can actually pay the taxes. What this is saying that at least 25% or more is actually outstanding. So stated differently, then obviously 75 or more percentage of the payment has not been received. Okay, and very importantly, this relief can only be applied after having applied other relief sections, and the most pertinent one there is the section 11J. Okay, that's a provision for doubtful debts, as I've referred to, and I've covered that in class. So obviously the number that we are deriving off here is after having applied the relief that we've actually got already under section 11J. Okay, then certain instances where this will not find application, that's important. So obviously this applies primarily where you are selling trading stock under a suspended sale agreement. That basically means that if you are selling trading stock under extended sale agreements, for example, your normal credit sale agreement is 30 days within which to pay. You say that I can allow you 60 days within which to pay. That's not technically a suspended sale agreement where you're going to charge finance costs. That is merely extending your normal sale terms itself without charging any interest. That is an example of what would not fall into here. What would fall into here is the sale of trading stock, which meets the definition of an ICA Part A, i.e. there's interest, and we need the suspensive clause to actually sit in the underlying agreement itself. So we need to meet that four requirements that actually sit in Part A of the definition of an ICA. Another example of a sale that would not fall into this into Section 24 is, for example, where you sell a capital good. When one sells a capital good, what happens? Technically, you have a recoupment, and even if you sell that capital good on a suspended sale agreement, what's going to happen is technically, because it doesn't fall into Section 24, that there will simply be a recoupment of the past deductions or allowances, and for the seller, he's going to actually get a capital gain or loss that we're going to calculate ultimately. Happy with that. And for the buyer, obviously, he's going to now buy an asset. It depends whether he holds it as trading stock or as a capital asset as to whether he can go into Section 22 or alternatively then into his capital allowances that he or she can get. Okay, so that's what we're into. Let's have a look at what's going to unpack and what's going to happen. Let's start with the VAT. I told you it's very important that we always start with the VAT considerations up front and first and foremost. So let's have a look. From a VAT point of view, we said that the moment the time of supply is triggered, and the time of supply is going to be triggered on the earlier of delivery or payment, what's then going to be the value of supply? The value of supply is then basically going to be the entire amount itself. Okay, so both for the buyer or the seller, what's going to happen is that the moment we trigger that time of supply, the earlier of delivery or payment, what's going to happen is that the full output over there, as we can see, is going to be declared by the seller, and the full input, as we can see, is going to be claimed upfront by the buyer on day one. Okay, so that's easy. That's the VAT scenario, and we've sorted that out. Now we can basically cross over into income tax. We're now into income tax, and let's assume that we're actually selling trading stock. What's going to happen is the trading stock, remember, is sold under an installment credit agreement, so it meets the definition of an ICA. We're going to basically have to pay income tax on the whole amount. If there's some amount of that debtor that is actually that's doubtful, we can basically claim a Section 11J on that, and on the balance we're going to then get a relief the way I showed you, and the calculation is going to be calculated under Section 24 itself. Okay, then we basically have a look, and this is just dealing with the capital component, because we've sorted out the VAT over there, and now we basically then need to deal still with the interest. So let's continue what's going to happen with the buyer on the capital. Obviously, if the buyer buys this asset, one has to ask yourself, how does that buyer then apply that asset in the business itself? If it's going to be trading stock, we're into the whole trading stock lecture, Section 22. If it's a capital asset, it's one of the allowances that taxpayer could possibly be claiming. What about interest then? Interest is simple. I taught that to you also in the lecture, in the past lecture, and what we said is if it meets the definition of Section 24J, quite simply, it meets the scope requirement, then we're going to go day-to-day calculation, both for the buyer as well as the seller over there. So that's quite simple over there in terms of how we're going to deal with the interest component. If it does not meet the definition of Section 24J, we're not out of scope, we're not finished. We can still go to Section 11A to determine whether we can actually get the interest deduction or accrue the interest under gross income accordingly. Okay, so having said all that, we looked at the scope, we looked at the implication. Broadly, the scope is that we need a suspended sale agreement, technically of trading stock. The implication is going to be there's going to be some kind of relief because there's a problem. The solution is going to be the relief that's going to come about. Now let's basically deal with this little example that we got going over here. So in this example, we got a seller, and the seller acquires a new machine that's immediately selling us Section 12C's being applicable. The 40%, probably if I look at the date immediately, it gives me a trigger that we're going to go for 40% over there. Okay, so it's a new sale of a machine. It is sold as trading stock. Okay, so we're quite happy from the seller's point of view that we are selling trading stock. It's reminding me, it's taking me into the scope of Section 24 itself. On 1 September, the sale actually takes place. That's my date of the sale itself. And then they tell us that on the 6th of September 2019, right, Steady Pace Limited bought a new machine with a cash value of 345,000 in terms of a suspended sale agreement. Now, there we go. We have that clause coming in, which is a suspended sale itself. Okay, and they basically tell us a cash value. That term should be triggering for me immediately that I'm now going into Part A or Part B of an ICA. We do know that 345,000 is an amount that is then a defined term in the VAT Act, which is then VAT inclusive. Okay, so we've got a seller that actually acquired this machine as trading stock. I basically held it as trading stock, but what I done as a seller, I then decided to take the trading stock and sell it, but I'm selling it under a suspended sale agreement. And it is going to be used in the manufacturing process as defined, obviously, by the buyer itself. The machine was invoiced and delivered on the same day. That is important from a VAT point of view, because we know that the moment we have payment or delivery, that's going to trigger my time of supply for VAT purposes, and on that day we're going to basically declare the full output and claim the full input on the cash value over there. Now they tell us that 3 payments are going to take place. We're going to basically pay 144,876, and this must be paid in terms of the agreement on 31 August 2020 and 31 August 2021 as well as 2022. So we've got 3 payments, annual payments in arrears that's going to take place. Ownership transfers when the first payment is made. Now, can we all see that that is technically your suspended sale agreement? I've sold this good trading stock to you. You're going to pay me over 3 years, 144,876 per annum. Obviously, I'm not going to sell you at today's price. It's going to be interest built into those repayments itself. So that repayment got a little bit of VAT. I'm a VAT vendor. There's going to be a little bit of interest in there, and the balance will then be capital. If we then unpack that 144,000. Now, obviously, because I'm selling this to you, and transfer of ownership only takes place when that first payment is made, i.e. on 31 August 2020. That, my dear ladies and gentlemen, is a suspended clause that sits in the agreement itself. And that triggers Section 24, and my thinking immediately to go to Section 24 for application purposes. The seller originally paid 230,000, so that's my cost. That's I'm the seller, but I first bought it at trading stock. I actually claim that a deduction, obviously, for that because I'm a VAT vendor. That's my Section 11A, and I hold that then as trading stock. The seller's trade consists of selling machines on deferred payment basis. So that's the nature of my trading business. I actually do sell these things on suspended sale agreements. Right, and the buyer and the seller both have a year end of 31 August. So that's my information that I'm left with, and now I basically need to unpack it and have a look and see how we're going to drive the solution. We now obviously have to deal with both the buyer and the seller. We're going to have to split the consequences between the VAT and the income tax implications. So here they give us then the actual amortization table. I may or may not give it to you, but basically what it does is, you know, from a management accounting point of view, it will split it between the capital, the VAT, then the interest. So there's the whole amounts. And what we're doing going here is we're technically splitting that 144,000 on each payment between a little bit of the interest, the VAT component, and the capital over there. Right, so I may or may not give it to you. These are normally management accounting and the ability to use a financial calculator. If it's given to you from a tax point of view, take it at face value. Do not recalculate what we've given you. You can assume it to be correct. You don't have to check the numbers. Run with the numbers that we've actually provided you. Alternatively, if we get to integration, where we want you to first run the table itself and then apply the tax implications, then you'll have to actually do the amortization itself or the table itself. So let's have a look. We first of all said, let's unpack that scenario. We said what has happened here is technically we got a seller selling trading stock on a suspended sale agreement. We first need to deal with VAT, so we write down VAT over there, and we first turn to the buyer. And let's sort out the buyer over there. So what's going to happen for the buyer and the VAT implication, quite simply, is initially what we're going to get going over there is, let's just get the laser pointer going over here. So there we go. The first issue, it is falling squarely into part A of an installment credit agreement. Therefore, what's going to happen on the earlier of payment or delivery, we're going to immediately claim the VAT input times the cash value times 15 divided by 115. Then we can turn to the income tax for the buyer. Now, when we go to the buyer, what has actually happened here, and they told us that this buyer is actually going to claim this, and he's going to hold this asset as an allowance asset, and his line of business is a process of manufacture. Therefore, he can claim immediately at 12C. We go to basic principles. You buy an allowance asset. 12C, you're in the process of manufacture. You're meeting all the requirements. You have actually acquired this on or after 1 March 2001, and therefore you can apply the 40% over there. There's no issues. Okay, and then don't forget the interest deduction itself, which you're going to get from the table in the past over there. That's basically our interest deduction, 43,000. It aligns up quite nicely in this example. I just want you to see that with the year end, so there's no apportionment happening on the day-to-day basis, because that payment is actually aligning up with the entity's financial year end. But if that payment that 43,000 had to cross the year end, and that accrual period crossed between two tax years, we would have had to apportion that 43,000 on a day-to-day basis. So technically, even though in this example we fall onto Section 24J, it is an instrument, it meets all the nice scope requirements, it says calculated on a day-to-day, but effectively what's happening, that day-to-day is actually amounting to 365 itself. So there is no apportionment on a day-to-day in this example. Okay, then let's have a look. We then go to the seller over there. What's going to happen in his instance over there? The first issue we want to sort out again. It meets the definition of an ICA Part A, and he's going to have to declare full output on day one, the earlier of delivery of payment. We're going to take the full cash value. We're going to times it by 15 divided by 115, and that's my full output that I have to pay over. Now we get into the fun part, which is the Section 24C, the Section 24, and that is basically where I now have sold trading stock in terms of a suspended sale agreement. So what Section 24 then tells us is the whole amount is deemed to accrue to me on day one. So I'm going to actually calculate and put in 300,000, and I'm going to actually have to pay income tax on that. But because that has created a problem at that level, what I'm going to do is calculate the relief immediately, and the relief is going to be calculated on the GP percentage. We've actually calculated that. I bought this good for 200,000, I'm selling it for 300,000, therefore I can calculate my GP percentage over there, and I'm going to times that by the outstanding amount at year end. So if we go back to the table itself, that is the capital itself that we're going to use and derive off our allowance. The reason for that is that I've just shown you from the purchaser's extent that we've already sorted out the VAT, we've already sorted out the interest. So the balance that we're technically dealing with is actually the capital, and therefore the allowances that you're going to drive off is obviously the remaining capital. Does that make sense? Okay. And also when we do test our limitation, we obviously want to see from the table, one of the requirements over here is that more than 25% of this capital is actually is due or payable after 12 months from this date itself. And it is quite clear that they've paid very little of the total 300,000, and more than 25% of the 211 of the 300,000 is actually due or payable after 12 months of the sale agreement. So that was a key requirement over there that we wanted to check. Obviously, if more than 75%, as I said earlier, was in and received, Section 24 relief is not going to apply, quite simply because then you actually got the bulk of the cash up front over there and you don't need the relief. Okay, so there our relief comes in. We're going to calculate it. We're going to actually put that in. And then obviously don't forget the easy mark, right? Because this taxpayer actually bought trading stock, they can get 11A deduction because the closing stock is no more on hand at year end. They're not going to have any add back to closing stock. So that becomes a real deduction for this taxpayer in that year itself. And then don't forget, he's also going to have to account for interest accrued. And in this case, that 43,000 again doesn't cross the year end. So quite nicely, we do into Section 24J, but we actually not doing it on a day-to-day basis because our accrual aligns nicely with the year end. Okay, so that basically brings us quite nicely to the completion of both dealing with the buyer as well as the seller. Let's just look at a quick reconciliation as to what has transpired over here. We can basically see if we apply that GP percentage over there, and if we go back to the table, we look at that actual payment that we actually received. That's the cash that I actually got, the capital cash that I got, and we apply the GP percentage on that. That is the profit that I basically made on the cash payment actually is 29,000. And don't forget, we also got interest accrued this year, which is 43,000. If we ignore the VAT, because VAT is not your money, it is actually just collected on the state's behalf, on SARS behalf, paid over to them, then we can quite simply see that if we follow the cash, 72,000 is what I actually got out of this deal this year. And if we look at that, that is the 72,000 that we actually are accounting for as taxable income. That's the point that I want to actually show you over there. So technically what we are doing with the Section 24, with the whole relief that we give you, we're taking into account and accounting for the entire gross income up front on day one. We are basically going back to a cash flow basis itself. Okay, so that brings us quite nicely to the completion of section 24. I'm going to now basically quickly go into donations tax. I'm going to move a bit quickly on that, because this you have dealt quite substantially with in your undergrad. We're going to just start off with broad. What is the implication? Why is it that companies and trading entities are basically given a deduction under Section 18 Cap A if they actually make a donation to an approved PBO? And obviously you need all the documentation in order. You need a PBO certificate in order to get that deduction. So here is a company actually making a donation to a company, and what happens is SARS is turning around and saying, hang on, we will give you that donation as a deduction limited to 10% of your taxable income. It is for that reason that, because we have a limitation and a drive of your taxable income, that has to therefore be the last deduction that the company is going to basically be making. And if we look at what the policy thinking, why we're giving that is basically for philanthropic purposes, obviously out of goodness of your heart, out of the generosity. If we did not actually give companies these deductions, what is going to happen is that we're going to see that the PBOs that rely on these income will probably suffer and struggle, and in time they're going to actually close down itself. So obviously from a business point of view, it then makes logical sense as to why this is in. Now, when you make a donation to a PBO, let's just unpack what are the issues that's going to trigger. We got to start off with VAT, and the first issue is that when you make a donation, there's a possible output tax adjustment, because you're going from within the bubble. You've actually exited the bubble itself. You're going from 100% taxable supply. On this donation, you probably got an input tax deduction, and you want to watch out for that. If it's a denied input, it will have no implications, but if you got an input tax deduction, you're going to now have to declare and correct that by declaring an output under Section 18(1) times 15 divided by over 115 times the open market value. So that's quite simple, but remember, as I said previously in class, if we can't measure, so if you're going to get some publicity benefit in the return and you can't measure that open market value, how you're going to calculate that? In that case, there is a supply that's actually happened, and the supply will be deemed in terms of the VAT Act to take place at null value. Okay, let's then go to the income tax implications. The income tax implications, if you're basically selling an allowance asset, what is going to basically happen is that you deem to have sold that at market value. Section 84K deems it to be sold at market value, and you can calculate your recoupment under 84A accordingly. Okay, if it happens to be a trading stock that's then donated, we remember from the class that I done a lecture on, in that regard, we said if we donate trading stock to an approved PBO where you get a Section 18A certificate, we're going to basically recoup that at the tax value. However, if it is actually to a non-PBO or PBO that is not where you don't have the necessary 18A certification in order, that's going to basically be a deemed recoupment for you at market value. In addition to that, don't forget, if it's going to an approved PBO, you have the certification in order, you can now get a tax deduction for that, limited to 10% of the taxable income before the deduction. Okay, so that deduction is going to basically be limited to in terms of your limitation rules. Therefore, we notice that this has to be the last deduction that you're doing. Let's have a look at the capital gains tax implication, because when we're going to now start crossing over into CGT, we're going to see that the sale of an asset or the donation of an asset triggers a disposal of the asset, which means that technically we have to do a capital gains tax calculation. But however, if that is going to a PBO, paragraph 62 in the capital gains tax is going to also give you relief and tell you there's going to be no capital gain or loss implication on that. In other words, it's not necessary to even do the calculation itself, because the relief is being applied blanketly to a PBO as well. And then if we basically come to the donations tax implication, remember, when you actually make a donation, it's gratuitous in nature. And when I'm going to lecture you on donations tax later in the year, you'll know from undergrad, when you make a donation, you obviously reduce that by, if it's a natural person, by 100,000, if it's a company, by the first 10,000 of the casual gifts, and thereafter you're going to pay at least 20% donations tax. It could be escalated. It could be higher than that. It could be 25% nowadays. But basically, we're going to pay the 25% donation on any donation that you make, less your basic exemptions over there. However, notice again, what it's doing is that if you make the donation to an approved PBO where you have the necessary documentation in place, it's a certification and a certified donation. What's going to happen? No donations tax. So we can see quite nicely from a flow is that if we actually donate to a PBO where you have the necessary documents in place, you get philanthropic and public exposure, no VAT implications. We're going to have income tax, so we're basically going to get a deduction for that. CGT is going to be a null effect over there, and your donations tax is no implications over there. Quite nicely, it's making sure that you have no tax consequences over there. Okay, let's have a look. Donations of cash or assets. Remember, you can donate cash. It could be an asset as well. If it's going to a PBO, you get the Section 18A. Notice the position. It has to be the last deduction that you're going to basically do. And obviously, because we have the 10% limitation. Now, what is the calculation? What value you're going to derive off? If it's cash, it's easy. But when it becomes asset, it's all various valuation rules that you're going to find listed quite nicely for you in Section 18A. And what I've basically done on this slide is really to actually just summarize what is written in Section 18 for you. And that basically determines the value that you're going to basically derive off for in terms of calculating your donation tax deduction under Section 18 Cap A. So if it's cash, it's the actual rand value. If it's a financial instrument which is held as trading stock, it tells us it's the fair market value or the Section 22.8 value. So it's either fair market value or your trading stock written down values, your tax value over there. And if it's other trading stock, it's actually the Section 22.8 value. So it's obviously always in that case the written down value over there. Okay, so those are quite simple. Those rules sit quite nicely. I'm not going to belabor the point with these. Capital asset, we have a special rule over there. And if we basically have property that's manufactured, assembled, constructed for the purpose of the donation, we have a special rule over there. And lastly, if we have an asset that is not trading stock or used by the taxpayer, again, a nice special rule coming in over there. Make sure you've got these things clearly demarcated and highlighted in the Act. Even I sometimes forget these rules over there, and make sure that you can quickly go to it, navigate to it, and find the valuation rules in terms of what you need to go into your deduction on. Then we have a special rule sitting for there, and know this, I taught you that in before in classes as well, is that when you donate something big like an immovable property, then obviously there's going to be a special rule, and we find this special rule written into the Act itself. Make sure you have highlighted that, and if it does come out, then we basically apply that special rules over there. Okay, it's not common for entities to actually, I've got it in grayscale because it's not quite common in practice for entities to actually donate an asset as large as a immovable property to a PBO. When it does happen, it's rare instances, but if it does happen, just know that there's a special rule sitting in Section 18A to calculate the value, and know that you where to find it, and once you found it, you will be able to quickly apply it accordingly. It's a simple rule. It's a formula that basically sits in Section 18A. Okay, then lastly, I want to basically deal with the issue of when does this not apply. So we've basically gone through when does it apply, but in certain instances we know that donations tax, you're not going to get the Section 18A even if it's still PBO. Even if you get the certification in order, you're not going to get it. And three instances come to mind. The first is if you actually going to donate a part of an asset, so use of a fiduciary or similar asset, that is basically a part disposal of an asset. It's not going to happen. Logistically and common sense should prevail. Why would SARS give you a deduction for giving part of an asset? You either give the whole asset, in which case we'll give you the Section 18A deduction. If you half give an asset, we're not going to give you a donation under there. So very logically, one would expect that to be written into the Act as an exclusion. Then an intangible asset, again, I would not expect that one would get a donation deduction under 18A to be written into the Act. Quite simply, it's almost like saying Coca-Cola is giving the intangible value of the Coke brand to a church or a mosque. What would a mosque or a church want to do with an intangible asset? They are a PBO, they are public benefit activity or entity. Now they're starting integrating, they are taking intangible assets like goodwill, trademarks, and those sort of things. That it is not their business to actually get assets of that nature. Therefore, if you give assets of that nature to them, quite simply, you will get no deduction under 18A for it. And then the third class that we basically find there, again, very logical, is a financial instrument like a share in a PTY, a private company or close corporation, members' interest over there. You know, for management accounting, it is very difficult to actually value those private interests in companies itself. When it comes to a listed share, it's got a market value. It's listed on the stock exchange. We got the valuation. We know the number, so we will give you a deduction under 18A. But if it's anything with regard to a non-listed institution, a share in a non-listed financial institution, know very well you are not going to get that as a deduction because the valuation becomes quite difficult. Okay, example. So if you donate a patent, obviously to a PBO, that's an intangible, you are not going to get a deduction under 18 Cap A. If you donate shares in a private company to a PBO, again, I told you the valuation is difficult. Because of that, you are not going to get a deduction under 18A. But if you donate then a share in a public company like a listed entity, because the share is quoted on the stock exchange, we can then get a deduction under 18 Cap A. And that basically brings us to the end then of this recording. In the next session, we're going to basically go through and we're going to have a look at section 24I, and we're going to now deal with the foreign exchange gains and losses that we need to account on a transaction. Okay, thank you for watching, and that brings us to the end of this recording.